with all the noise that we get every day, it changes. How do you navigate the market? How do you read the Chinese market and handle it with all that's going on?
Right. So at the risk of really oversimplifying all the complicated dynamics, I think for the Chinese equity markets, at least in the medium term, there are really two top-down variables or drivers that are consequential to how we think about returns for China. Number one, obviously, is the trade tensions with the US. But number two, very importantly, is the potential policy offsets that could be provided by the Chinese authorities. Now, it's hard to say whether the 100% tariffs will remain in place and for how long, but let's assume that the tariffs will remain quite restrictive in the near future. We believe that the Chinese policymakers will come up with quite forceful and aggressive policy easing in the months ahead. And I think the upcoming Politburo meeting that could happen anytime soon will be a very important event to watch for. So if you look at our base case sort of assumptions, we believe that fiscal policy will become very expansionary this year. So when you translate that into equity market language, we still believe that corporate earnings for China will be at around 4%. And on top of that, valuations, we are now still at quite inexpensive levels. So our fair valuation forecast for China is about 11 times. So combining these two factors, we're still looking for about 8 to 9% potential upside for China over the next 12 months.
Okay, that's very, very favorable how you're viewing the Chinese markets. We've seen huge volatilities play out globally in the United States, mention of both technical and bear markets, whereas the CSI 300 has only seen about a 2.5% decline since Trump's Liberation Day. What is it that's isolating the Chinese markets? Is it really the national team? What is happening there?
It's part of the story. So national team definitely has provided some, I would say, explicit support to the domestic Asian market. So if you just look at the top 5 ETFs that are most favored by the national team, just last week we had about 100 billion RMB of net buying on these ETFs, suggesting that the national team is really coming in to provide some sponsorship to the stock market. But on top of that, I think if you just look at the historical context, Chinese Asians typically, they have lower sensitivity to external risks, right? And at the same time, I think they have also higher beta to domestic easing expectation. So I think combining all these different variables, I think that makes sense for China to do a little bit better against a backdrop where external risks are very uncertain and highly unpredictable.
Is there any expectation on your part for a financial bifurcation or a decoupling in the markets?
Decoupling meaning from the U.S.?
Yes.
I think, again, if you look at just historical correlation between the Asian market and the U.S. market, I think over the past 2 years, we are in a negative territory, meaning that I think China continues to provide some diversification benefits for global investors when it comes to the equity universe.
Now, as we talk about the trade war, Goldman Sachs has this U.S.-China relations barometer, which is a measure that you guys use to quantify U.S.-China friction in equity prices. Can you talk to us where that barometer is now?
So in essence, this is a tool that helps us to quantify to what extent the multidimensional frictions between U.S. and China are embedded in equity valuations. So if you look at the latest readings, we are now at 2 years high, which is not surprising, right? Given all the tensions about trade and also concerns about potential ADR delistings in the U.S. So clearly, from an equity market perspective, investors are quite concerned about the bilateral frictions between the two nations.
In terms of sectors, industries, which do you prefer in a market that we are currently trading in?
So basically, Emily, there are 2 keywords that really cut across all our preferred strategies in China. And the 2 keywords are, number 1, policy, number 2, domestic. So we've recently made some changes in terms of our sector allocations. So we upgraded banks and property developers to overweight. And the common denominators among these 2 sectors, basically they are 100% domestic in terms of revenue generation. Number 2, valuations are inexpensive. Number 3, positioning is light. But more importantly, when it comes to policy, we believe that they're in a better place to receive more policy support down the road.
What about technology? Because that is also, of course, inward focused as well. I'm just seeing a line here from Baidu. They have launched Ernie 4.5 Turbo and reasoning model Ernie X Turbo. This is according to Baidu, being reported by Reuters. In terms of the AI race and the technology that is coming out from China, is that a sector you like?
Very much so, but more on a strategic, longer-term basis. So about 2 months ago, we wrote a pretty comprehensive report really laying out our views or our kind of longer-term expectations for the AI development in China. So just to put a few numbers on the table, we believe that against a backdrop where you're talking about more wide adoption of AI in China, that could translate into incrementally 2% earnings uplift every year over the next decade. So clearly, this is a game changer in our view when it comes to corporate profits and how investors perceive the investment case for Chinese equities. So, but we think specifically within the AI ecosystem, we believe that cloud operators, companies that have a lot of data, and software companies, they are in a better position to monetize the AI development in China in this stage of the cycle.